Hi, hello, good morning, everyone. And thank you for joining us today on this very special session on what are hybrid funds and how investors can use them in their portfolios. My name is Ashwin Patni. I'm head of products and alternatives at Access Asset Management. And I will try and take you guys through this over the next hour or so. We also have this opportunity to take up a lot of questions so I will go through a few slides and take you through some background. But I'm also very keen to take up as many questions as I can. So let's use this opportunity to get as much as we can about what are hybrid funds. These are very important options to investors for creating a good long-term versatile portfolio that can be robust in different market environments. And investors should have a good sense of how they can use them. So let's jump in. The most important thing to note about hybrid funds, as the name suggests, they are called hybrid. What do you mean by hybrid? Hybrid is something where you combine, two different things or a few different things into a common product. And why are hybrid funds called so? Because they combine different asset classes into a common fund. What do we mean by asset classes? Asset classes are nothing but a common group of securities or common group of investments which perform in a similar way in different cycles, and depending on the environment, the economy, and factors around them. So a classical example for an asset class is equities or bonds. As we may know, equity markets, typically you could have different stocks listed within the equity market, different sectors, but they tend to follow a common cycle. If you whether you buy stock from a particular sector, another sector, typically if the market goes through a correction, then these stocks also will react. If market is going through a good cycle, typically you get them. So they follow that broad cycle. So allocation to equities follows that particular cycle. Likewise, if you look at bonds or, for example, gold, again they follow their own different cycle, and typically that is what you mean by asset class, which is you can allocate to securities within that category and get a particular experience within that. Now, the thing to note that there are different asset classes. We've got these three on the chart on the here in front of us, which is stocks, bonds, and gold. Stocks is another name for equities, bonds or debt or fixed income, whatever you want to call them. Gold, of course, we all know. So look at these three, and the thing is that different asset classes perform at different times. This is a lot of data that goes back to the last 20 years. What we have done is taken each calendar year starting from 2001 onwards till 2020, and for that calendar year, what was the return that stock market gave, bonds gave, and gold gave. Very interesting observations. For example, look at 2008. Stock markets fell 50%, but bonds and golds were up 27%. Look at a very conversely another year like 2017, the stock markets gave 30% returns, but bonds and gold were barely above 0.45% each. Another year like 2003, where stock market gave a very handsome 77% return, bonds, gold gave good returns, but much lower, 12-16. So what's coming out clearly is that they tend to follow different cycles. And why should different asset classes follow different cycles? Is because they get moved differently by different kind of economic variables. Very simple way to understand: equity markets, as we all know, are driven by growth. An environment where the economy is doing well is typically an environment where earnings of listed companies can also grow much, and therefore typically is a supportive environment for equity markets, and we see equity prices going up. Conversely, an environment, if you look at an environment where economy is going through a tough time, let's look at when there is a recession or when there is a crisis, growth potential obviously gets challenged, and that is a time when we see equity markets correct. let's contrast this behavior of equities with, let's say, how bonds can behave. Bonds are typically influenced by interest rates. Now, interest rates typically behave depending on the economic cycle in a converse way. So when economy is going through a really good patch, typically interest rates move higher, and that's an environment in bonds underperform. An environment where interest rates are falling, which is typically seen in reaction to weak economy, is an environment in which you see good mark-to-market returns from bond investments. So this is a very nice complementary mix. If you just noticed, equities did better in good economy, weaker in weak economy, bonds typically the other way around. So that's what you come out, and that's what is coming out in this table as well. Trajectory of its own. So that's the most important reason why a hybrid or an asset allocation product exists, which is that uh, you have asset allocation that uh, 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 different asset classes that can combine and do give complementary experience to the investors. And when you mix them up, that is the what a hybrid fund essentially is all about. Let's go further. And let's look at what is the importance of this terminology which I just used, which is called asset allocation. Now, asset allocation, asset and allocation to different asset classes, which means that instead of putting all our money into any one uh, uh, performing asset class like equities or debt, if you had, let's say, 100 rupees to invest today, and the choice that you can make is you could put the entire 100 rupees into equities, saying that equity markets do really well in the long run. Or the option is you say that you put entire money into debt, saying that, I want more stability. I don't want the risk which equity markets periodically go through ups and downs. Uh, Contrast that with a scenario which is what is called asset allocation. So instead of putting entire 100 money in any one, you say that let me mix it up, let me have part of it in equities, part of it in bond, part in gold, etc. And what is the benefit of this asset allocation? We have a bunch of these things here. The most important thing is that it just reduces risk in the portfolio. Why does it reduce risk? It's very simple, and the answer lies in what we just saw in the previous page, which is these markets, they go through complementary. Many times when equity markets are falling, debt markets are doing well. So if your money is not in just one place, but it is spread across these two places, then typically at a portfolio level, the risk that you run comes down quite materially. So yes, asset allocation reduces the risk. Second, as a corollary to that, or as a complementary part to that, therefore, it helps provide an extent of downside protection. It's not that asset allocation portfolios will never fall. Of course, they can fall as well, but the extent of downside, therefore, what we mean by downside is how much can you fall from your base level, of course, comes down quite materially from individual asset classes like equity. Third, you continue to benefit from active management. It's not that just because you've done asset allocation, because we know that active funds have added a lot of value, whether it's on equity, debt, any of the asset classes. Uh, Asset allocation does not take away from that. Even though you are allocating to different asset classes, or in a hybrid fund, you're mixing allocation to these ones, there is still a fund manager who still is managing actively each of these allocations, whether the debt allocation or the equity allocation. So therefore, you're getting the benefit from the diversification, but you're not losing out on the active management component of the portfolios. Fourth, periodic rebalancing, and this is a very important, although something that we not normally sort of grasp easily, and I will just spend a minute on it. Periodic rebalancing helps buy low and sell high. What do we mean? Think about an asset allocation, a very simple asset allocation, let's say 50% in equities and 50% in bonds. Now, in an environment like last year, heavily affected by COVID, let's take our minds back to last exactly about a year ago, March, February, March, we saw a heavy sell-off in equity markets. Almost, markets were down almost 50% at one level. at one time. Now, if you started with an equal allocation, which is let's say 50-50 to equities and bonds, and very simply speaking, if equity markets went through a 50% correction, your actual market adjusted allocation would get more lopsided, because if instead of being 50-50, because if equity markets have fallen, the allocation would look more like 70% to debt and 20% or 25% to equity. Now, such an exposure, what that will trigger in a hybrid fund, because hybrid fund have to regularly maintain that 50-50. So if you are in a fund which has to maintain 50-50, that fund would in this environment move a little bit of its money out of debt and move it into equities. So it's moving money into equities when the equity markets have had a severe correction. And therefore, it allows you to buy at a lower level. Same way, look at it in the other side of the year, when after the correction we saw in the latter part of 2020 and earlier part of 21, a massive rally, and not just a recovery, but a massive rally and a new high from the equity markets. In that environment, assuming you had got back to 50-50 in debt and equity markets, let's say going up 50-60%, would put equity exposure far higher than what this 50-50 target is. In that environment, the fund manager will move out of equity and move it back into debt. So this kind of a regular rebalancing, what we call a regular sort of shuffling between debt and equity to maintain a consistent level, is actually a very good way of averaging out, because typically it will always put that discipline of you to put more into an asset class which has had a weaker run. And typically then that is the concept of buying low and selling high. Notice also that this is almost opposite of what a greed and fear cycle would force a normal investor to do. In our case, all of our case, we will get scared by an equity market fall, and instead of adding more equity at that time, a lot of us may probably would choose to cut back on equities. Likewise, when markets are doing very well, instead of looking at or revisit the balance, we typically are very comfortable adding more at that stage. So normal investors get swayed by greed and fear. Hybrid funds, because they have to maintain a consistent allocation, are able to look through the greed and fear cycles and move on a very systematic basis and take advantage of that. Number 5 is lower correlation, which we already spoke about, but we'll show some data around that as well, which is to say that because markets are moving in sort of different pace to each other, or a different cycle to each other, their experience is different in different times. So if you take a 3-month window, their correlation with each other, how closely they move, is actually quite low. And then finally, the number 6 and the final one is the tax efficiency. Hybrid funds allow you to be extremely tax efficient, because the entire rebalancing, the entire management of the asset allocation happens inside the fund, and therefore for the investor there is no tax incidence. If you were trying to do the rebalancing at your end, you would buy into equity, buy out of equity, buy into debt, buy out of debt. There will be a lot of transaction cost and tax cost that will come in. But within the hybrid fund, everything that happens inside the fund is essentially very tax efficient, because it does not lead to any transaction at the investor level, and still the investor is able to get the benefit of the hybrid allocation. We spoke about low correlation. Let's look at some numbers. Essentially, a correlation number, the way to read it is if something has perfect correlation, if they're moving in complete sync, that is close to 100%. If something has completely opposite correlation, they move completely opposite to each other, it will be a minus 100%. And if something has no correlation to each other, it will be close to 0. So it's a range that goes from plus 100% to 0 to minus 100%, depending on how closely the asset classes move to each other. And what you find is that, interestingly, gold, for example, is very close to 0 to marginally negative to equity and debt. Likewise, equity and debt is very marginally positive, but again, very close to 0. So what this is bringing out is that the cycles in which these asset classes are moving are completely separate from each other. And therefore, that is the real reason why when you allocate to these asset classes in a composite way, you are able to get a reduced risk or a reduction in your overall risk without necessarily compromising on returns. Let's look at some data. We have looked at a simple hybrid allocation. And this is for the last 20 years. What we did was, what is the return profile of stocks, what is the risk profile, and the kind of what is called the drawdown or the maximum loss that has been seen in stocks, in bonds, and in gold. So again, it's not a surprise. Equities have given the highest return, but are also the riskiest asset class, whether you see it in terms of what is called standard deviation, which is nothing but volatility, or in terms of the drawdown. Bonds, on the other hand, while have lower return but are much, much lower on risk. Gold typically is somewhere in between. Now, when you combine this in a particular mix, this is just one sample mix that we have taken. There can be a host of different combinations which are possible. So when you combine these in a particular mix, then what you see is that you get a dramatic reduction in the volatility or the drawdown without the same level of reduction in the risk return that you see compared to equities. So if you refer this combination versus, let's say, the equity combination, equities over 20 years have given 14.2% per annum return, and have a volatility of 18.8%. When you combine equities, bonds, and gold, what you end up with is very close to equities like return 14.1, with a much lower volatility, which is almost 30% lower. 18.8 in place of 18.8 falls to 13.2. Even if you see it in a very simplistic way in terms of the maximum fall, instead of close to 60%, it's closer to 40% that you see. So that's the sort of like, you can almost say it almost works like magic. And you know, many people have sort of said that, including one of the most famous quotes is that diversification is the only sort of free lunch in finance. Which is, why do they call it free lunch? Because you are getting a dramatic reduction in risk without the same level of reduction in your returns or performance. And essentially, therefore, it's a free lunch because you're enjoying a similar return profile with a much lower risk. And that's what the power or the magic of hybrid funds are. Again, just to reiterate, there are different types of hybrid funds. We've just taken one sample allocation to showcase the power. Essentially, the concept will work the same. The exact numbers, of course, will be a function of the mix that we use between stocks, bonds, and gold. But the concept will remain the same. It doesn't matter whatever mix we use. To some level, that benefit will be seen. As you can imagine, in the mix, the more equities you put in, the more the numbers will start getting closer to equities, whether risk or return. The less equity you give, the more debt you keep, the more the numbers will be more towards the debt part, etc. So there are so many different types of hybrid funds. That's the other thing to note, because as I was saying, you don't have to be just one mix, or there is not just one correct number that works for everyone. And different people can have different allocations that may work for them. And as I was explaining, some people may want within the hybrid space also something which has lower risk, and therefore within equity and debt, those investors could go for a mix which has more debt, less equity. And some other investors could go for a mix which has relatively higher risks, which has therefore a much higher exposure to equity, lower exposure to debt. So it is a continuum of sorts, and there are lots of different allocations or product baskets which are available. If you look at within the mutual fund industry, there are a number of clear asset allocation buckets which are available. Of course, the two extremes are your dedicated products, the debt funds and the equity funds, that you can see from the chart. And then in the middle, you have these three funds, which are hybrid debt funds, what are called equity savings funds, and what are called hybrid equity funds. And then you have a fourth category, which is more of a dynamic category, where basically the allocation is not a common one, but it actually manages on a dynamic basis. So four broad categories of hybrid funds that exist, just to repeat. And also what you can see in this chart is typically this is on the risk return continuum, which basically is a function of how much allocation is there to the higher risk category, which is basically the equity category. And the more you got closer to equity, the overall risk of that product is higher. but also the potential return from that is higher too. So hybrid debt products therefore are relatively closer to debt, have a little bit higher risk return potential than regular debt products. Hybrid equity products are closer to equity and a little bit lower compared to pure equity products. Lying somewhere in between, you have equity savings funds with more like 40-40, or more closer to the 50-50 mark as far as debt equity mix is concerned. Let's look at these in more detail. This slightly technical, but it's an important thing for people to understand. The mix is right because it's very important for investors before they invest to understand what kind of mix a particular product will give them. Um, Ultimately, the kind of experience you will get will be very large, to a large extent, driven by that mix. As they say, asset allocation explains 90-95% of a portfolio's performance. So essentially, the most important thing for you to know when you're allocating is what the asset allocation target of that category is. And based on what your overall targets are, you can select the correct mix that will work for you. So this table gives you that mix. Typically, conservative hybrid fund or the debt hybrid funds, as we said, typically have predominantly all their money in debt. So as high as 75% plus of the money lies in debt, and only the balance money lies into equities. There is typically no gold allocation. So these are very conservative structures, as you can imagine. The second category is what is called the aggressive hybrid fund, which is on the other extreme, where typically more than 65% plus, or as high as almost 80% of the money is lying in equity into equity allocations, and only the balance lies into debt. So when you have that kind of an allocation, that is from a risk perspective much closer to typical equity experience, and therefore has to be seen in that respect. Somewhere in the middle is the rest of the three categories which are there. As I mentioned to you, dynamic asset allocation is something that there is no fixed number. It can move dynamically from a lower equity allocation to a higher equity allocation, and typically tends to achieve something that is more closer to 50-50. And this is basically something that allows investors to also get a more dynamic experience, because otherwise, you have two ways of doing asset allocation. One is what is called static. So the number is fixed at all times, and always the fund manager, whenever it goes up or down because of market movements or something, the fund manager brings it back in line. Or you have a dynamic exposure where, depending on the market environment, the exposure can keep changing. So today's environment, if it is supportive, then for equities, then the fund manager can choose to run a higher equity exposure. Suppose 3 months down the road or 6 months down the road, it is less supportive to equities. The fund manager has the ability to reduce it. So that's a little bit more active management that investors get. And it's a fantastic solution for investors who are looking at not a fixed allocation, but something that is dynamically managed through the cycle. So that's the dynamic asset allocation products. That's the third category. The fourth category is the one where if investors, what is called multi-asset, and the beauty is that investors get to not just limit themselves to debt and equity, but also get exposure to gold in it. Gold can be a very powerful additional component of diversification. As we all know, in India, we have a culture where we allocate money to gold, and there is a very strong reason for that, because gold essentially works as a good insurance against macro or currency shocks. So whenever the environment becomes challenging from a crisis or something perspective, then chances are that both equity and debt could struggle for a period of time. And that are times typically when hard currency assets like gold typically are able to be more resilient compared to debt and equity. So multi-asset funds offer you that combination of debt and equity and gold all into a common product, typically at least 10-15% each in debt and gold, but higher number in equities. And that's something that you achieve through the multi-asset allocation products. like at the Axis Triple Advantage. And finally, you have equity savings, which is more like 40-45% in each of the asset classes. So roughly an equal asset class allocation between debt and equity. So just to repeat, you have conservative hybrid, more debt, less equity, 75-25, closer to that. Then you have equity savings, which is more like 50-50. Then you have equity hybrid, which is the more aggressive. These are the three that are on the continuum. Apart from these three, you also have the dynamic allocation products, which can move dynamically depending on the environment. And finally, you also have what are called the multi-asset allocation products, which combine not just equity and debt, but they also throw in gold in that, allowing you to combine these in that. Now, the question that investors can ask is there are a lot of these choice categories. So how do we decide which is the right category for us and where should we invest? The answer is very simple. And as I said already briefly, ultimately it boils down to what your portfolio objectives are, what kind of risk you can handle, what kind of horizon you have. For investors who are more risk averse, who are more conservative, or if their horizon is shorter, typically the rule of thumb is that their equity exposure that they can run with is lower, and therefore they should have higher exposure to more stable asset classes like debt. For investors who have a much longer horizon, have the ability to withstand more volatility along the way, their ability to handle risk is higher, so therefore they can afford to have much higher equity exposure in their portfolio. So this is one rule of thumb which can be used at, and people can look at that to decide which of these categories work for them. My suggestion would be also that you do look at how these funds have performed in the past as well. It gives you a good clue of how they did in different cycles, and that can give you a sense of which of these funds can work better for you given your risk profile or your expectations. So ultimately, it's not that everyone should look to invest in all of these. The reason we have so many funds is because different investors have different expectations. So the idea is more that each of the investors understand what works for them and finds the correct mix in which they allocate rather than trying to allocate multiple of these at the same time. And let's summarize with that in terms of what we've discussed today, which is that hybrid funds are essentially a method by which they allow investors to invest in more than one asset class in a single product. That's why they are called hybrid funds, because in the same fund, you are investing in multiple asset classes. These funds, they allow investors to achieve asset allocation and without timing the market, because the fund manager is managing the mix between debt and equity and gold for them. So the investors don't have to worry about those things. That's something that gets taken care of by the fund manager. And indeed, they get all the benefits of active managed portfolios within these funds as well. Thirdly, and very importantly, combination of different asset classes can really reduce overall portfolio risk because these asset classes are not correlated. That's the whole sort of the most central and most important takeaway from this session, which is these asset classes move separately from each other. And so when you combine them, you can achieve a very good improvement on your risk return profile as a result. And finally, so there is a lot of tax efficiency to hybrid funds. Some hybrid funds, of course, offer equity taxation, but even when they don't, the reality that inside the fund, all the rebalancing and all the movement between debt and equity is happening inside the fund makes the overall experience very, very tax efficient for the investors. With that, I'll pause here in terms of my remarks. As I said at the beginning, I also want to make sure that we cover a lot of questions. We have got the link open for all the participants to put in their queries, and do write in all your questions, and I'll try and cover them one by one. Also, one quick note is that, of course, we do have limited time, and there are lots of questions which are already coming. So while I will try and take up as many as I can, in case I miss out on taking up your question, you can reach out to our call center and our help desk lines. The details of that are provided in the details of the webinar. And you can reach out to us, and we will make sure that we cover your queries, whatever queries there are. So with that, let's start answering some of the questions. One sort of recurring question which has come in different formats is that relation to the age profile of the investor. So I've got a question on whether hybrids are suitable for investors above 60. There's another question on whether they are suitable for young investors or for investors that have a long horizon, and what should be the ideal holding period. So with respect to age, like I already said, I hybrid work funds can work for all age profiles. That's the first and the simple answer. Whether you're 60, whether you're 20, whether you're any age in between, there is no problem. All age investors can use hybrid funds. The trick in terms of how to use them is to, as I said, understand what we are trying to achieve. Today, even for a 60-year-old investor, given our life expectancy, etc., you still have to plan for a 15, 20 years, assuming even if you're retired at 60, you have to plan for a life which is 20 years plus. And, during that period, you have to be able to protect your portfolio against inflation or cost of living, etc. So it's important not to lose sight of these things and have appropriate asset allocation and appropriate allocation to equity and debt, even at whatever age you run. But of course, your risk appetite will be not the same. It will be lower compared to what somebody else who has a much longer horizon can. So that's where the beauty of having different hybrid funds comes in the picture. You have funds which are at different levels, and for more senior people who have a lower horizon, maybe you can consider funds which are on the lower end of the risk spectrum. For people who are younger or who have a much longer horizon, you can consider funds which are on the higher end of the risk spectrum. Typically, what should be the investment duration or horizon? So that is another question that in different form or shape is getting asked a lot in terms of what should be the correct holding period for these funds. Ultimately, to make the best use of hybrid funds, these are not market timing type of design products. These are essentially products that are meant for long-term savings. So really, to get the best use out of this, you should really plan to use them in the very long term. When I mean by long term, maybe 3-5 years and beyond. Ideally, if your horizon is 10 years, 20 years, you can use it for those type of horizons, but definitely use it for a horizon which is beyond 3-5 years for sure. The idea is very simple. In the short term, markets can go through ups and downs. You don't get a full cycle. So your experience can get really distorted. Very simple example, if somebody had just invested for only 1 year in 2019 and taken the money, look to take the money out in early 2020, and you could have faced the massive correction that equity markets went through, your entire experience would have been distorted. Whereas investors who have been into equities for say 5 years, 6 years, and same thing can be true of investors who have been in hybrid funds for the last 5-7 years, the return profile gets much, much more stable and predictable. So therefore, horizon is very important in terms of being able to handle different types of market movements and getting the experience of a full cycle. One important and very, very pertinent question is on the difference between a hybrid fund versus directly investing in an equity debt funds. Of course, as again on this chart also you can make out, as a mutual fund, we offer dedicated debt and equity products. We also offer hybrid funds, which offer a combination. So for an investor, what should be better depends on their own, propensity. Some investors like to create their own mix, and they are slightly more sophisticated, or they have a larger portfolio value, so they can actually construct it on their own in terms of dedicated equity and debt products. Some investors who don't really want to get into that kind of a hassle, they want to keep things simple. Hybrid funds work very well because it's like a one-stop shop. In the same fund, you get the entire allocation between debt, equity, everything gets set up for you. So it's not that one is better than the other. Both have their own utilization. As a fund house, we try and offer a wide choice to investors so that each can select whatever works for them. As I said, both of them will be very, very similar, but one simple way of looking at it is if you allocate directly to equity and debt, you have to be much, much more proactive in your tracking of the portfolio in terms of what is going on, what you want to do. For example, if market goes through ups and downs, the allocation can suddenly seem very distorted. So you have to take steps to rectify this. Also, you have to keep reassessing in terms of what is your regular allocations, where to put it. Whereas in the case of a hybrid fund, this rebalancing, everything gets done by the fund manager inside the fund. So it's very, very convenient for the investor because the entire rebalancing, everything is done for them directly by the fund manager. So that's the huge advantage that hybrid funds are able to do. Which is the best hybrid fund, or how should I choose a hybrid fund? Is it better than any of the equity funds? So one question, I'll split this into two parts because there is one recurring question in terms of what kind of returns hybrid funds will get and whether they are similar to equity fund returns. And the answer is that especially the more aggressive hybrid funds, which have material equity allocations like the equity hybrid funds that we have on this chart, etc., you could get a return profile which is quite similar to equity return profile. But on the whole, the reason to invest in hybrid funds is not to get equity-like returns, but something which is maybe a bit lower, broadly in that ballpark, but a bit lower, but with dramatically lower risk and much better protection as far as risk profile is concerned. So that is the one to really keep in mind. And therefore, if you want equity-like returns, then go to equity funds. When you come to hybrid funds, you should be mentally be prepared to get a slightly lower return profile. But as I said, also the compensation or the benefit or the trade-off that works for you is that the risk actually is far, far lower compared to a pure equity. The related question was which hybrid fund to invest in. I thought I've answered that, but I'll just repeat that quickly. There is no one fund that works for everyone. There is no one perfect hybrid fund, or there is no one best hybrid fund. Different funds can work depending on the horizon or the risk appetite that investors have. And equity hybrid can work for someone, and debt hybrid can work for some other investor. What should be the way to invest into hybrid funds? Should we invest them now? Should we look at regular investments like SIPs, etc.? I think SIPs make a lot of sense. Of course, if investors have some lump sum, hybrid funds work well for lump sum as well because you are mixing the allocation, so you're not unduly affected by one market up and down. But equally, they work very well for SIP investors, and it's a great way to invest into hybrid funds, especially the more aggressive hybrid funds where equity exposure is higher. I think regular allocation makes a lot of sense. There is a related point on which is a good hybrid fund for an SWP or for a regular income. Typically, it depends on the level of income that you desire. What the rule of thumb that we have is that typically, as we said, equity markets are able to give better return than debt. So hybrid funds that have higher equity exposure, like equity hybrid funds, typically can sustain a higher level of income or higher withdrawal rate in an SWP. Whereas a debt hybrid fund, which is much more conservative, will be able to sustain a much lower rate of SWP. Moving on, there are some questions on the market, which is, markets very close to an all-time high, equity markets especially. So how does that affect the risk profile of investing into the hybrid fund? And should we sort of look at investing right now or try to wait for a better level, etc. for that? My response to that is that there is no real right time or wrong time, and timing the market is not easy for anyone. So therefore, if you're very, very worried about market timing, you could look at this option, which is a very attractive option, which is the dynamic asset allocation product, because that is something where the fund manager does have the ability to allocate to different, to maneuver the equity exposure based on the market environment. So that would be one way in which you can sort of rely on an expert or using a systematic approach to get a different equity exposure over a period of time. Having said that, for most investors, I think it's much simpler to just keep allocating on a regular basis and not worry about timing the market or what the level of the market is. So my recommendation would be look at a regular SIP type of allocation. Don't worry about the market levels. Just a simple example I will tell you, even investors who invested at the previous market peaks, say in 2008 or 2013 or 2011-12, uh, actually if your holding period is 5 years or longer, you end up making reasonable returns. So these things, they worry you or they move you in the short term, but they don't really affect you so much in the long term. And point number two, market ups and downs will hurt you much more if you're in a dedicated equity product. When you move to a hybrid product, that's one of the beauty of the hybrid funds, which is that they dampen the risk or they dampen the volatility quite materially. So to that extent, while you are the markets can go through ups and downs and it can affect the value of your holdings, the impact will not be as high as what it would have been in a pure equity fund. And that's another reason why when you're choosing hybrid funds, you can be a little bit more relaxed about worrying about market timing in that sense. There are a bunch of questions on whether hybrid funds are better than equity funds like a large cap fund or a flexi cap fund, etc. And whether they can get returns just similar to equity. Again, I answered briefly, but I will repeat it because there seems to be a question that is coming up a lot, which is that you should not compare a hybrid fund to a large cap fund or a flexi cap fund or an equity fund. Their objectives are very different. Their approach is very different. An equity fund is ultimately entirely allocated to the equity markets, whether it's large cap in the large cap side of markets, flexi cap in the large and mid and combined, diverse geared towards giving you an equity exposure. As we spend the last time discussing hybrid funds, the main objective is not to look at just one market, but to combine exposure to equity, debt, and multiple markets and give you a much better, smoother ride, so to speak. So inside in hybrid funds, they have equity exposures, and those equity exposures are managed just like how a large cap or a flexi cap fund will be managed. So you get the benefit of active management just like a regular equity fund. But ultimately, the objective of these hybrid funds is to give you a much smoother ride or a much more balanced approach over a period of time. And that's why you should not compare the two. Ultimately, if you want to achieve an asset allocation, hybrid funds allow you to do that. If you are looking at a dedicated equity exposure, it's better to stick to an regular equity product. There's a question on which of these hybrid funds in the portfolio can they go up much higher level of equity when the environment is right. If you look at this table, two funds that have the ability to take much higher equity exposure, much higher than even 65. One is the dynamic asset allocation product. As I mentioned, and I will just quickly repeat, the dynamic asset allocation product is about managing equity exposure on a dynamic basis such that the exposure is brought down when the environment is not suitable. It is dialed up when the environment is more attractive. So that, depending on the attractiveness of the environment, can go to much, much higher equity exposure or significantly higher than 65 if the environment is suitable. On the other hand, you also have the equity hybrid or the aggressive hybrid fund, which is the second number on this. That again allows the fund manager to run an equity exposure which is much higher than 65. So for those investors who are looking at hybrid funds which have a quite substantial equity exposure, these are the two options that you could look at. There's a question on if I'm investing in a hybrid fund, is there a need to have a separate exposure to an equity fund? And the answer again will boil down to how large your portfolio is and how much you are looking to actively look at it over a period of time. Again, there is nothing wrong about having a separate equity and debt exposure as well, complemented by hybrid. Just keep in mind that ultimately you have to track equity and debt exposures much more minutely compared to hybrid in terms of whether the market ups and downs doesn't distort your asset. which are the recurring question is, which are please recommend some funds which are for the long term, etc. So like I said, it will be difficult to do without knowing the background. I have tried to explain what the key features of each of these categories are, but if you need to have a more specific discussion on what may work for you, please reach out to us directly on the call center, and we will try and give you something that can work for you depending on your background. There is one interesting sort of question on whether what the tax efficiency of hybrid funds is now. Equity-oriented hybrid funds are, because there is now the LTCG on equity is no longer 0, but it is 10%. So is it better to split between equity and debt, or whether it is directly this thing? See, again, the taxation on equity will come whether you invest directly into equity or into an equity-oriented hybrid fund. Equally, the debt funds also have a taxation. So hybrid funds have a very important tax efficiency beyond what their tax rate is, which is that all the rebalancing, etc., that needs to happen inside the fund is completely tax efficient, because the fund manager can buy equity, sell equity, buy debt, sell debt inside the fund without affecting you as an investor. So that is something that when you invest directly into an equity and debt fund, that is something you have to keep track of, or you have to do some regular management, and that could lead to some tax implications which could affect you. So there is one significant advantage. So yes, the tax situation has changed with the introduction of the LTCG, but even then, overall, it continues to remain a highly tax efficient and a very attractive proposition from an investor's perspective. Probably time for the last one or two questions. I think it's been, we've tried to cover as many as we are. As I already said, to the extent that I really apologize if we've not been able to cover, because there are lots of questions and we had limited time. We would recommend you to reach out to us directly on the call center or on the email, and we will try and cover the questions. There's some question on whether to, I think again, number of questions on same line that, investors, I have somebody who's retired and they want to invest. So what should be the right approach? And I answered that briefly, and I will just sort of quickly touch upon again that you have to identify your horizon. Even if you're retired, let's say even if you're 60 and you're retired, you have to keep in mind what is the horizon that you have ahead. It could still be 15, 20 years. And depending on that horizon and the kind of risk appetite, you could identify the right hybrid fund. The same hybrid fund doesn't have to work for all types of investors. If for other investors who have much more risk appetite, they can go for more aggressive product. Someone who's retired probably can go for a more conservative product. So that's something that is the beauty of the hybrid system. So with that, we come to the end of the webinar for today. Try to answer as many questions as I can. Thank you so much for joining us, and we hope that you found this session useful. And do reach out to us if there are some more points that you need clarified, or any other topic that you want us to cover for our webinar series. We'll be very happy to do so going forward. So thank you, everyone. And with that, we can conclude the seminar for today.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks.
Ashwin.
Read all scheme-related documents carefully.
Okay, so
mutual fund investments are
the
subject
questions
to
were becoming a bit
risks.
repetitive.
Read all
so I was
scheme-related
looking at this,
documents
and then I said, then I tried scanning to see if there were some quick ones. And I said, anyway, I also realized the time was becoming a bit long. So then I said, I might shut it. So
no, it was good. It was good.